delighted
No
to be
worries.
joined by Nathalie Goldstein and Migla Kuzmata from MyExpatTaxes, who will be discussing US tax reporting for Americans living abroad in 2023. Nathalie was named in Forbes 30 Under 30 list last year. She is a US expat based in Vienna and co-founder and managing director of MyExpatTaxes, the leading online US tax filing software specifically created for expats. She is also an accredited IRS enrolled agent. Migla is US tax lead at MyExpatTaxes. Thank you both very much for joining us. And how are you today?
We're good. We're good. Thanks for the introduction. And, just note with the last name, I always say there's the proper Austrian way to pronounce my last name. And then that doesn't matter the minute you step into American ground. And I guess we're kind of in American ground right now. I've even been corrected by a flight attendant telling me that that's not how you pronounce my last name. It's not Goldstein, it's Goldstein, and that's the way it is. Okay, but I can go ahead and start sharing slides because we're not here for my
Well,
last.
hold on. Let me, before you do, just for our audience, please bear in mind that the information presented is for general educational purposes only, and you should always seek your own personalized financial advice. And also, Nathalie will be answering your questions at the end. So please add them in the Q&A pop-up at the foot of your screen as and when you think of them, and we'll try to answer them all, time permitting. So without further ado, over to you, Nathalie.
Perfect. So let me go ahead and share my slides. And we can get started. So yeah, as Hugo said, I'm Nathalie. I'm from California, now based in Vienna. I have to say, December is wonderful because of Christmas. January to February, I'm not a big fan. It's too cold for me, but can't complain that much. Regardless, my background's in finance and information technology. And essentially, when I moved abroad, I realized there was just a huge gap for US expat taxation preparation in terms of tax software and firms. And it was very disappointing. I remember trying to get my first tax return done. My company didn't want to do it for me, even though they had moved me to Austria. And then at the same time, when I had looked at kind of the Big Four or any other kind of expat boutique firms, they were very expensive. And to be honest, a lot of the preparers weren't expats, so they didn't actually really understand the case I had. And so then I tried the software route because, coming from California, I always believe in software. And those softwares failed pretty terribly because they just couldn't grasp that I was someone living abroad making foreign income that had to file a US tax return. But long story short, that is what prompted me to create MyExpatTaxes. So we're the leading US expat tax software where anyone can go in. If you have a simple case, you can definitely, do it yourself and go through that process very quickly and affordably. If you have a more complex case, you can always opt to work with a tax professional like Migla, who's on the call with me and is always there as my backup, right? So really, any case you have, we're here for you just to help make this tax filing experience a lot nicer, because it's not fun that you have to file a tax return when you don't even live in the country. So what will we talk about today? Obviously, you're here more for kind of Expat Tax 101. You'll have the more detailed sessions after this one. We'll also talk about FBAR and FATCA, because even though that's not technically a part of your US tax return all the time, it is very essential to the whole filing requirements you have. Obviously, a little bit about Expat Tax Benefits. Everyone says you're never double taxed. What does that really mean? And, what deadlines are for this year, and if you need to be tax compliant, how to get tax compliant. And of course, major changes in 2023 because we're in a new tax year, and to kind of understand what's going on for this new tax year. So we just jump into the most general question. Who needs to file a US tax return? And the answer to that is pretty simple. So it's all US citizens or US green card holders that pass the filing requirements. So the filing requirements for this tax return is on the screen. Just keep in mind, you always file your previous year's tax return in the current year. So we're filing 2022 tax returns now in calendar year 2023. I know that can be a little confusing sometimes. But essentially, when you look at the filing threshold, it comes down to how much worldwide income do you have? And when you think about worldwide income, it's really income from all sources. So you're not just counting US income, you're counting all sources of income. So say you have a salary from Germany, maybe you worked in the UK before, so you have some pension income from the UK. Maybe you once upon a time you lived in Australia, so you have a rental property in Australia. So all of that income, the gross amounts, meaning, the total income before any deductions, expenses, and or taxes, you combine that all together. And if that worldwide income is over the filing threshold, you have to file a US tax return. It's pretty much that simple, so to say. But there's always exceptions. So I jump into the first ones, which is married filing separately. People get very confused because obviously the standard deduction for married filing separately is generally the same as single, which is true. It's still $12,950 this year, the same as single. But the filing threshold for married filing separately is extremely low at $5. So they had actually changed this for tax year 2018 and they never reversed it. And basically, I think any expat that is married to a non-US citizen will most likely be using the married filing separately filing status, because I'm sure that your, NRA spouse, non-resident alien spouse, probably doesn't want to be on your US tax return. And so if that's the case, you have to file as married, but you don't file with them. So you're married filing separately. Of course, if you have, a US child that's your dependent and they have a US Social Security number and you're otherwise eligible, you could always try to use the head of household filing status. But like I said, most expats married to a non-US citizen end up using married filing separately. So just be aware that that filing threshold is extremely low at $5, and it doesn't seem like it's going to change anytime soon. So another thing I want to call out is if you're self-employed, even if this is not your main job, if you just have some freelancing income on the side, right? You did, a few small jobs on the side in 2021. If you have over $400 of net self-employment profit, you have to file a US tax return, even if you don't otherwise meet the filing thresholds for your filing status. And that's because when you have self-employment income, you might be subject to US self-employment tax. And that already starts at $400 net profit. So that's why if you have more than $400, you have to also file a US tax return. Obviously, there's a couple other exceptions. So for example, if you might be subject to, IRA taxes or other taxes like that, you have to file a tax return. However, generally, these are the most common filing requirements, so to say. Of course, if you're over 65, the filing requirements are a little bit higher. So just keep that in mind. I don't put all the numbers up there, but other things to note is if you don't meet the filing requirements, you might still want to file a tax return. So I say this, it's mostly, I would say, for tax year 2020 and 2021, is I'm sure you've heard about the stimulus payments. And basically, even if you didn't make any money, you could have been eligible for the stimulus payments, but you had to file a tax return if you were, you didn't get into this one window where you could have applied for the stimulus payments without a tax return. So if you haven't got the stimulus payments, or maybe if you're up for any other refunds like the child tax credits, even if you don't meet the filing requirements, you might still want to file a US tax return because you can't get a refund unless you file, right? So something to consider. Might also be an option for those expats that maybe they had worked in the US, they got a W-2, they had federal taxes withheld, and maybe you don't have enough money to make you file a tax return, but if you had federal taxes withheld, you might want to file a return so you can get a refund. So that is something to consider there. Again, I mentioned if you're over 65 that your filing thresholds are increased. Another big question we get is, what about your children, your US children? Do they have to file a tax return the minute they turn 18? That's not the case. So age is not really a factor. It's not that the minute your, children turn to adults at 18, they have to file tax return. It's, again, dependent on the filing thresholds, right? Most likely your children are single, so their filing threshold is the same as a single filer. The only thing to watch out for is if you have dependent children on your tax return and they have unearned income over $1,150, you might need to include their unearned income on your tax return, or in some cases, they might have to file their own tax return. So unearned income is things like interest income, or, maybe they get some type of retirement benefit from, a past parent or something like that. So something to just note there, if they have unearned income, then you do have to watch out a little bit more for your dependent children. And, obviously filing taxes from abroad to the US is something we have to do. It's a legal requirement. The screenshot I have on the slide here is from your US passport. So in the back of your passport, there is something that technically has been telling us that we need to file US tax return every single year. Obviously, I don't think people look at the back of their passport so much, and it's okay if you didn't realize you had to file. So if you're sitting there and you're listening to this and you're going, oh man, I had to file a tax return, I didn't know, now I'm in a lot of trouble. don't stress out. There is an amnesty program. I will briefly cover it in this session, and there's a bigger session later on in the day about streamlining. But again, if you realize you had to file and you've never filed, there is an amnesty program for you. So just stay tuned and don't sit there stressed out for the rest of this session. So along with your US tax return, there's also this amazing US federal law called FATCA. It's not really that amazing, but it's essentially a double reporting requirement. So you would have noticed when you opened up a bank account anywhere in, Germany or Australia or France, etc., they probably had asked you to sign a lot of different documents the minute they found out you were a US citizen. And that's because essentially any foreign financial institution has to report US clients' assets to the US Treasury. Now, that's what your financial institution has to do. Because we're talking about the US, there's always this double reporting requirement where even though they have the information already, they would like you, the taxpayer, to also report that same information. So basically that boils down to you possibly having to file one of two forms or possibly both forms, and that's the FBAR and Form 8938. So the FBAR is kind of the first level of this reporting for you. If you have a combined maximum balance from all your foreign financial accounts of over 10,000 US dollars, you have to file the FBAR. It's also known as Form 114. Just note the FBAR does not actually get attached to your US tax return. That's sent separately to the Financial Crimes Enforcement Network. I know this is a big question and people don't realize that it's not really attached to your US tax return going to the IRS. However, again, you may have to file an FBAR, and if you have to file an FBAR, this goes to essentially the Treasury and not the IRS. Now, if your combined max balance from all your foreign financial accounts is over $200,000 or, over 300K at any point during the year, obviously, if you're married filing jointly, these amounts are doubled. If you're living in the US, you can pretty much cut these amounts in half again. But for the average expat, if it's about over $200,000, you'll have to file Form 8938. This is an extended version of the FBAR. It just has a few more questions. It looks a little bit more intimidating. Same information, essentially. And this actually does go in your tax return, and this has a penalty. So if you don't file either of these forms, both of them have about a $10,000 penalty. So just be mindful that if you need these forms, make sure you file them. One more thing is obviously, again, if you're thinking, oh, I haven't filed these, I'm in trouble, there's an amnesty program for the FBAR itself. And also, since Form 8938 is including your tax return, the streamline procedure will also cover that as well. So just keep in mind that there's always a way to kind of get compliant if you haven't filed them. So what I said too is a little confusing, I think, for most people, that's just the way they kind of create the rules, is it's not about your average balance. It's not about your ending balance in these financial accounts. It's about your maximum balance. So just remember that you need to know what your maximum balance is per financial account. So a quick example here is just, say you have 3 bank accounts, but obviously we're talking about financial accounts. So it could be brokerage accounts, it could be retirement accounts, any type of financial account. So if you have 1 in the US, 2 in the UK, you ignore any US accounts. We're only talking about foreign financial accounts. You would look at your foreign financial accounts, so your, in this case, UK bank accounts, and you would look for the maximum balance. So this is not the easiest number to get. I can acknowledge that most banks don't give you a maximum balance. I would say you can either use monthly statements to see kind of which month had the highest balance in it. If you are a little bit more trying to get the exact number, you can always kind of get the running transactions from your bank and then figure out what the maximum balance was. But that's obviously for someone that's a little bit more of an Excel whiz. Monthly statements are okay. That's actually part of the instructions for the FBAR. But essentially, say that you had 5K pounds on January 1st in your bank account number 1. And then you had 6K pounds in your second bank account on December 31st. You would add those two maximum values together to get 11K. You obviously then convert that to USD. using the right exchange rate. So that's usually the year-end exchange rate that's provided from the Treasury. And if that's over $10,000, you have to file an FBAR. And the minute you have to file an FBAR or 8938, you include every single foreign financial account on there. It's not that you only include the ones over $10,000, but you include every single one that your name is on. And it can be joint accounts, right? So ones that you own with your spouse, even if they're a non-US citizen spouse. It can be accounts that you have signature authority over for your children. It can be accounts from your company that you have signature authority over. So anything with your name on it, essentially. With that in mind, if your spouse, if you're filing jointly with your spouse and your spouse has separate accounts from you, they may have to file their own FBAR, right? So then your FBAR would have your accounts plus accounts you share with them, and then their FBAR would basically be the same. Their accounts and then accounts they share with you. If your children also have accounts, they might have to file their own FBAR. So not just because you file an FBAR and it references, your spouse's and or your children's accounts, they may also be subject to filing their own FBAR as well. And one more thing is it can be double counted, the maximum balance. So this is a question we get all the time as well, is what happens if, say, that $5K that I had in bank account number 1, I just transferred to bank account number 2. Surely you don't count that, right? You do. So it doesn't matter if it's the same amount of money just getting transferred between accounts. The minute any account gets a maximum balance, you add those maximum balances up together. So keep that in mind. And another big question we get is, online accounts, how do you handle that? There's not clear guidance on it. I just say if you have like an online bank account, look at where you signed up with that online account. If, the service you're using is based in the UK or based in the US, that's kind of where I would go off of. So that was the FBAR. These are other expat tax forms. So when you're filing US tax return, you're going to see so many forms in there, and it's going to be pretty overwhelming. I can acknowledge that. So this is essentially the most important forms you should look at. What you'll first see is Form 1040. And just keep in mind, if you're a US citizen or a US green card holder, you have to file Form 1040, even if you live abroad. Some folks think that because they live abroad, they'll be filing Form 1040 NR, 1040 non-resident. But no, if you are a US citizen or a green card holder, you're technically always a tax resident. So you'll always be filing Form 1040. So with that being said, 1040 is your overview form. It's very long. There's a lot of schedules attached, hence S1, S2, S3. That just means Schedule 1, Schedule 2, Schedule 3. There's really a lot of papers, so to say, attached to this Form 1040, but that is your overview. That's going to tell you how much income you make, what deductions you're taking, what credits you have, how much you owe, how much refunds you're getting, right? This is also going to be the address you put onto your return that you tell the IRS. This is basically where they can mail any correspondence to. If you want to put on a US bank account for any refunds, this is also the form where you do that. So with that being said, that's the most important form, but there are a couple other forms you should look out for. So, I would say the money form, right? If you're familiar with it, and if not, we'll get into it, is the child tax credit. So if you are, a US family abroad, you have US children, they have social security numbers, they're under the age of 17, you might already be getting these refunds from the child tax credit. And if so, you should be looking for Form 8812, also sometimes referred to as Schedule 8. This is the form you use to claim up to $1,500 per qualifying child this year. It used to be $1,400, it's slightly increased. With that being said, maybe you don't see this form. And if you don't see this form, it's generally because of the next form I'm about to mention. And that's the foreign direct income exclusion. So this is the most common expat tax form, I think. And if you see this form in your tax return, it basically just says you're excluding, a certain amount of your foreign earned income from US taxation. So you can exclude up to $112,000 US in this tax year. And this is, like I said, kind of the blanket expat tax form. So if you go to, any tax firm or tax software, they mostly try to use 2555 because it's a little bit easier. We'll talk about the pros and cons on the next slide, but this is a form that you may see in your tax return, and that's what it does. The next one is 1116. This is the foreign tax credit form. So this just says, I paid foreign taxes in the UK, in Germany, in Australia, in Singapore, and I can claim how many foreign taxes I paid in that country on my US tax return as a credit. So this is another way to not be double taxed. Another form you'll see is Form 8833. This is just claim a tax treaty benefit. So obviously there's a lot of tax treaties out there with the US. Whether or not they're useful for you is a question there, but if it is useful for you, you'll see 8833 in your tax return. There is a penalty on this form if you don't include it. It technically says if you don't file it, there's a $1,000 penalty if you use tax treaty benefit without disclosing it. I've never seen this penalty enforced, but just letting you know, it's a very important form to include in if you're using tax treaty benefits. And of course, as I mentioned, FBAR and Form A938, if you need them, they're also very important forms because they also carry penalties on them. So those are kind of the main forms to look out for. You might not have all the forms, you might have all the forms in your tax return, but essentially these are forms that are very common for expats. So what are these expat tax benefits? I talked about, again, there's going to be a session on double taxation that will go very in depth into this. I just give you this quick overview. So there's the three main expat tax benefits that help you not be double taxed. The first one is the foreign earned income exclusion. So that's on Form 2555. And normally you can exclude about 100K plus of foreign earned income from the US. Now, keep in mind, as it says in the name, the income must be foreign. So foreign income in this sense is income that you physically earn while you are outside the US. So say you are working for a German company, you have a German salary. They send you to the US for a month to work. That 1 month you're physically in the US and you're working, the salary you get in that month is not foreign. That is US sourced. You cannot exclude this on the foreign earned income exclusion form. The other part of the name is earned. It must be earned income. Earned income is generally salary, self-employment, active partnership income. So money that you actively work for, and it's not investment income. It's not passive rental income. It's not social security benefits. It's not pension income. So it has to be earned income. So you cannot use 2555 for your UK pension benefits. That's what I'm trying to say here. Essentially, it's a very easy form. Relative, right? Relative to all the other forms, it's relatively easy to use this form, and that's why it's so commonly used. It's pretty straightforward for those that are living abroad for more than a year. You can pretty much just tick a few boxes, say how much you earn, and call it a day. It's great for countries that have low income tax rates, right? So even if you end up not paying income tax where you live, you're a digital nomad, or you just live in a country that doesn't, you don't have income tax there, this is an amazing form, right? To make sure that you're not taxed. Cons, because there's always, pros and cons to each side. The cons is that, like I said, if you have US children that would be eligible for the refundable child tax credits, the second you include this form in your tax return, you're no longer eligible to get the refund. So that can basically, turn your tax return from going, you have zero taxes owed, but you have a zero refund. Whereas if you didn't include this form, maybe you would have a $1,500 refund annually. So something to consider. Another thing is if you want to contribute still to your US IRA, I know you just had a few sessions on kind of investing stuff as an expat. If you want to still contribute, this form makes it a little bit harder because you do need taxable compensation to contribute. So if you exclude all your income with the foreign earned income exclusion, you have no taxable compensation. Again, that's a topic in itself. I can't go more in depth into it, but it's something to also keep in mind. And the thing is, once you use the foreign earned income exclusion, technically you need to keep using it, because the second you say, I don't want to use it anymore, I want to use something else like the foreign tax credit, you have to revoke it. And when you revoke it, you have to revoke it for 5 years. So it can be, obviously if you don't plan on moving, you're staying in a high income tax country, it doesn't really matter. But if you're moving around a lot, it can be a little bit risky, because then you lose the right to use the foreign earned income exclusion for 5 years after you revoke it. So basically, if you start, you should continue, or you have to think about it a little bit before you kind of switch over. And that is why, if you use MyExpatTaxes, we generally try to use the foreign tax credit. It's a little bit more flexible. And like I said, it just uses your income taxes paid abroad to offset US taxes owed. It is difficult, in my opinion, to use because it's a lot of math involved. I mean, it's basically 2 full pages of just pure math. And then on top of that, what you have to think about is there are different buckets of income. So you have to figure out what bucket of income your income source, like your income, is specifically in. So it can be in the general bucket. So that's normally salary. It can be in the passive bucket, which is, investment income, rental income, things like that. It can be in the resource by treaty bucket, which is essentially, say you have US dividends that are generally sourced to the US, but then Germany also taxes them. So that would be resourced by treaty. It can be in the foreign branch one, that's self-employment. I probably am boring you at this point, but I'm just trying to reinforce the fact that it can be pretty difficult to use this form. And then on top of that, you have the general tax calculations, and then you also have to create the alternative minimum tax, AMT calculations. So if you use foreign tax credit, you shouldn't be surprised if you literally see like 8 versions of this form in your tax return. However, the difficult part is the con, right? The pros of it is that you can claim the additional child tax credit. So it can get you to 0 taxes owed. And then on top of that, help you be eligible for a refund. It also does not exclude any of your compensation from being taxed, right? Because this happens after the taxation. So you have enough taxable compensation for an IRA if you want to contribute, assuming that you're eligible in, other regards to contribute. But obviously it's not ideal if you don't pay that much foreign income tax. So if you're in a country with low income tax, this is probably not the right approach to you, because the thing is if you don't have enough foreign income tax to cover how much the US will tax you, then the US will tax you that difference. So if you don't pay enough to a country, they'll definitely get that remaining piece of the pie from you. The last one is a tax treaty. So this is basically for certain income types, you can basically reduce the taxation or even exempt it completely from US taxation. This is mostly for kind of Social Security payments. The reason that being is you can look at the tax treaty and you'll see that there is an article for almost every type of income. But what you don't normally get is that there's a savings clause in every single tax treaty, which basically just says, as a US citizen, pretend that this tax treaty doesn't exist. I kid you not, look it up. That's what a savings clause is. They'll probably talk a little bit about it more in the double taxation session. But that is why tax treaty benefit is kind of hard to use, because one, you have to understand the tax treaty. And then on top of that, you have to make sure it's not subject to the savings clause, which basically means as a US citizen, you cannot use this benefit. And then you have to somehow put that on Form 8833 to say, I'm using this tax benefit. And if, like I mentioned, if you don't include the form properly, there can be a $1,000 penalty. Like I said, never seen it enforced, but doesn't mean it won't be enforced. If I just confused you, I'm sorry. I try to give you a more concise overview. Just keep in mind, if you're thinking about which tax benefit should I use, can I use all 3 of them at once? You can. Should I only use one of them, et cetera, et cetera. That is what MyExpatTaxes does really well, right? Our tax engine, no matter what tier you're in, if you're a do-it-yourself or you're working with a tax professional, the minute you put in your income, will automatically calculate, okay, what benefit is best for you and results in, the lowest taxes owed or the highest refund possible. And if there's a tax treaty benefit available, we'll automatically put it into your tax return. So that is, a benefit to using a tax software or a tax firm that's specialized in expat taxes, because they can kind of see from your income immediately, okay, what benefit is the best one for you. So now that we talked about, what's included in your tax return, when do you actually have to submit your tax return? So this year is kind of similar to last year. It's April 18th again. I mean, obviously it's always April 15th, but if the 15th falls on a holiday or a weekend, then it's the next Monday. So it's April 18th again this year. Just keep in mind, this is the filing deadline and payment deadline for those in America. If you're an expat, you don't actually have to file until June 15th. However, if you owe taxes, you still have to pay by April. So a little bit of a chicken and egg situation. Basically, what I want you to get from that is if you're used to paying US taxes because maybe you have a lot of US source income, or whatever reason you do end up paying US taxes annually, make sure to file by April 18th, because your taxes the filing may not be due by April 18th, but the payment is definitely due. So if you pay after April 18th, you will have some type of late fee or interest included. Now, if you don't expect to pay any taxes or you expect a refund, you can wait until June 15th. You don't have to do anything extra. It's an automatic 2-month extension. I will say that even though it's automatic, technically, whatever software you use or firm you use, or if you do it yourself, you do need to include a statement to your tax return saying that you are abroad and you qualify for this automatic extension. So it's automatic, but you still have to include a statement. That's what I'm saying there. So the IRS has to know that you are an expat. So you have to tell them that. Regardless, if you can't file by June 15th, you can always get a filing extension to October 16th this year. So you have to do that with Form 4868. And you can either e-file this form. So you can e-file it through MyExpatTaxes for free. Any other tax software should let you file this form for free as well. They should never charge you for it. Tax forms should also allow you to file this form for free. So you can file this form. I highly recommend you e-file it. You can also paper mail it, but at this point, paper mailing it, they're probably not going to receive it until like next year. So paper mailing might not be the best option. Another thing people don't know about is you can get the extension by paying $1 on irs.gov/payments via an extension payment. That's also a way to get the filing extension, but you have to do this before your tax deadline. So if you're in the US, you have to do this by April 15th. If you're an expat, you have to do this by June 15th. You can't wait until after your filing deadline. And of course, there's other filing extensions you get. I won't go into them, but there's an option to go to December 15th as well. And obviously, if you have back taxes, if you have prior tax returns you haven't filed yet, you should do it as soon as possible, because in the event you do owe taxes, interest and penalties are accruing every single day. So with that being said, if you haven't filed, there is a streamlining procedure. So, you'll get a really good session on this later on, but essentially these are the highlights. You have to file either original or amended returns, because you can use streamlining to submit amended corrected filings, right? You have to do 3 back years of federal returns. So that would be pretty much 2019 to 2021. And you would paper mail those returns. And then of course you would still do your current year return. And I would highly recommend you e-file that return. You would also include 6 back years of FBARs. So 2016 to 2021 is back years, and your current year. You can e-file all the FBARs. You never paper file an FBAR. You always e-file them, right? Because remember, they go to a different department, the Financial Crimes Enforcement Network. And the streamline procedure is great because, one, you've never filed, right? So this helps you get caught up. So even if you haven't filed for 10, 30 years, you only need 3 back years of federal returns, 6 back years of FBARs, and then you are tax compliant. In the other event, let's say you've been filing, but you didn't realize you had to include a certain form. So you didn't realize you had to include form, the FATCA form 8938, and that has a $10,000 filing penalty. Or maybe you realize you have a foreign corporate and you have to include, these other really extensive forms that have, $10,000 late filing penalties. You can use the streamlining procedure to also correct your tax returns and pretty much eliminate those late filing fees. So that's why I say it can be, original returns or amended returns. While filing taxes can sound very scary, especially when I talk about all these penalties, I want you to know that most expats don't end up owing back taxes. So a lot of people that go through streamlining will actually get refunds, especially in light of the stimulus payments. So those stimulus payments, like I mentioned, for 2020 and 2021, altogether that's worth about $3,200. That's still on the table. You can still go through streamlining today and file those returns and be eligible for those refunds. So almost everyone at this point that's filing a streamlined return will end up getting a refund instead of owing taxes. And one nice thing is that, okay, if you don't pay the IRS in time, you owe interest, and their interest rates are pretty hefty. If the IRS doesn't pay you on time, they will pay you interest, which is amazing. Even if it's your fault, they didn't pay you because you didn't file a tax return. So like I said, it's very possible that, you feel that this is a huge task ahead of you. You go through streamlining, you end up getting thousands in refunds, and then you even get a little bit of interest on top from the IRS. It's taxable interest, but still, that's not bad, right? Keep in mind, I do want to call out that even though you have to paper mail your streamline returns, I still think that e-filing your current year returns is always the best so that you're in the system faster. Because at this point, paper mailing a return can take about a year or a year and a half of processing time. It's been pretty slow ever since the pandemic started. So always try to e-file if you can. A lot of tax softwares are based in the US, or maybe even tax firms that use tax softwares based in the US, they end up not being able to e-file for expats. So always kind of inquire about that first. Obviously, for MyExpat Taxes, we're built for expats, so we really, try to e-file every return as much as possible. And one note too is if you're married to a non-US citizen, you do not have to get an ITIN for them if you're married filing separately to e-file. That's just, that's a total myth. You can definitely e-file without them having to go through the process of getting an ITIN. So just, heads up on that. But basically try to e-file as much as you can. And, the streamline procedure is obviously a lot of years included, so it is pretty expensive. We do offer the package in MyExpat Taxes, so it's possible to pretty much go through the whole session in a day online if you have all the information ready, and we try to offer it for the most affordable price possible. However, of course, so many other firms who specialize in streamlining also offer the package. It might be a little bit pricier, but, whatever you feel comfortable with, right? Just streamlining is normally a good idea if you haven't filed, just to stay ahead of it and be compliant. And again, you'll probably get refunds, so you'll most likely make your money back. So that was all about taxes in general, filing, what to do if you haven't filed. Let's talk about what's specific for this year, right? Before we close out for Q&A. So for this current tax year, right, for 2022, what you can expect is the standard deduction increases. So it always increases a little bit every year from inflation. So it increases about $400 per taxpayer. I already showed you the filing requirement. So that's essentially the standard deduction, again, except for married filing separately. Another one is tax brackets have increased as well. The rates are the same, but the tax brackets have increased. That just means that, more of your money is taxed at a lower rate, for instance. So if you are taxed, so basically a good thing for you. The foreign earned income exclusion jumped up. So again, this is a number that usually increases every year due to inflation. So now it's $112,000 that you can exclude via the foreign earned income exclusion if you opt to use this form. And like I mentioned before, the refundable, sometimes known as additional child tax credit, it also increased. So it's always been pretty much $1,400. And now this year it's increased to $1,500. Just keep in mind, last year was a little bit odd with the child tax credit. If you had filed that form and got the refund, there was a lot of changes around it. The main thing for you to know as an expat is the amount that you can get as a refund. It has increased to $1,500. However, it's only for children that are under the age of 17 by the end of, or by December 31st, 2022. And the non-refundable portion is only $2,000. So another change that's not so great, depends on how you see it, right, is kind of goodbye to these pandemic refunds. So we haven't seen any stimulus payments in 2022. They only happened in 2020 and 2021. But basically the changes that you will see now on your tax return, the first one is not necessarily due to the pandemic. I mean, it might have been, there's no huge correlation, but it only kind of came about when the pandemic started, is basically in 2020 and 2021, what you could do was you could have the standard deduction. And if you made any charitable contributions, you could also deduct between $300 to $600 additional on top of the standard deduction. You can't do that anymore. It's no longer an above the line deduction, which you see in that screenshot. It's now only possible if you itemize your deductions. So that's gone for 2022. And like I said, there's no more stimulus payments. So there's nothing to claim in terms of stimulus payment on your 2022 return, but you can still back claim round 1 to 3 on your 2020 and 2021 returns. And not so relevant, I think, for most expats, but for example, if you had lived a majority of the year last year in the US, you would have seen really high refunds from the child tax credits. Like I said, it was a bit of a funky year last year. Anywhere between $3,000 to $3,600 per child as a refund. This was not for the general expat. This was for anyone that had lived 6 months or more in the US. But basically, you can say bye to those. So not happening anymore for this year. And even if you lived a majority of 2022 in the US and you only moved out, maybe for 3 or 2 months towards the end of the year, you could expect the same exact child tax credits as those that were abroad for the full year. So that is pretty much, expat taxes in a nutshell. I hope I didn't bore you and I hope I gave you good information. Obviously, if you're looking to think, okay, this is a little bit more complicated than I expected it, or I just want someone to do it for me, or I want to use a tax software to do it, look no further than MyExpat Taxes. Like I said, you can do it yourself. You can get it done for you by one of our tax professionals like Migla, who's also on the call. We are here for you and here to answer all of your questions about expat taxes, right? We deal with expats exclusively, so we're always here for you. I am also an expat taxpayer, so I know the struggle. We'll answer questions shortly. Hugo will start the Q&A session once I stop sharing my slides. I just want to note that if we don't get to your questions, you can always join our Facebook group. It's free to join. You can ask all the questions you want, and the community is there for you. If the community doesn't help you with your question, our team members will actually look for your question and pretty much ping the tax professionals in our team, and we'll answer those questions for you. So you're always covered, either way. And obviously, if you want to send us an email, you can always do so at team@myexpattaxes.com or join our Facebook group. Either way, we're always here for your questions. So with that being said, I will stop sharing and pass the ball back to Hugo for Q&A.
Nathalie, thank you very much. That was excellent. An excellent overview of pretty more or less the whole sort of landscape and all the rules for Americans living abroad. But we've got lots and lots of questions, so should we dive in? Olga from the Netherlands asks, I'm a sole proprietor. I'm considering changing my business structure and going into partnership. Does it change things for me in terms of US reporting?
It can definitely change things for you. So as a sole proprietor, you're normally reporting your income or your self-employment income on Schedule C. The minute you become a partnership, you will start reporting your income on Schedule E, and potentially, depending on the type of partnership you set up, how much you own, if you have other US taxpayers as part of the partnership, you could also have to file Form 8865, which is the partnership income tax return, so to say, which is included with your tax return. But basically, yes, it does change. You're reporting your income in a different way. So it can get a little bit more expensive to file your tax return to the US if you're in a partnership. It depends on how your partnership is set up. But yes, it will change.
Here's a question of somebody else from California saying, if you've moved abroad from California, is there anything in particular you need to know?
So moving abroad from California is, one, you'll miss the sunshine, depending on where you go. I miss the sunshine. But besides that, California is definitely one of the harder states in terms of state taxation. So I don't cover state taxation in this session, but in terms of states, you may still have a state filing requirement. So California is one of the tougher states in the sense where they say, okay, we don't really believe you that you're an expat. We still see you as being domiciled in California. With that being said, what I would say is, if you really want to move out and you really want to make sure you don't have to be subject to filing a California tax return anymore, make sure that you have your documents in order, that you really moved abroad, that you're domiciled abroad, your life is abroad, and that you're not spending too much time in California. Keep in mind, the minute you work for a day in California, you're going to be subject to filing California tax return because you might have California source income there. So long story short, California is definitely a hard state in terms of state taxes. And if you are trying to get out of state taxes, normally what people do is the year they move, they file kind of a non-resident California state return. You don't have to do it, right? But people generally recommend that you should do it so that you can kind of inform California you're now a non-resident. And then with that being said, just have proper documentation that, you really moved abroad, and don't, if you still own property or you go to California too much, or you work out of California, you may trigger California state filing requirements.
That's great. Here, Carrie says, my spouse is an EU citizen but has an ITIN. Can I file a joint return as long as I report my spouse income?
You can. So most non-US citizen spouses prefer, I think, not to be on a US tax return if they don't have to be, but you can also include them. You can get them an ITIN and you can make the election to file jointly. And once you make the election, it's basically in place until the day you decide to revoke that election. I just warn you that it's a one-time election. So if you file jointly with them, you have to keep filing jointly with them until you say, I don't want to do that anymore, and I want to basically stop filing jointly. And the minute you say you stop, you can never file jointly again. So it's a once in a lifetime election. You can do it. Some people do it. It might make sense in your situation. Most expats opt to married filing separately.
There are advantages. Am I right in thinking there are advantages to filing separately if you're married to a foreign spouse?
There's not necessarily advantages, I would say. I mean, it's a little bit friendlier because you could also go for the head of household filing status. But if you filed, I think one reason some people might file jointly is maybe their spouse already has US source income, so they would have to file a 1040 NR anyways, and this allows them to both be on the 1040 form together. Another reason is obviously the standard deduction for married filing jointly is higher than married filing separately, and the tax rates are lower for married filing jointly. So the IRS just treats married filing jointly better than married filing separately. I think the IRS believes that if you're married filing separately, you have something to hide. That is a reason people may do it. However, I have seen, it's a little bit of, I think, old guidance. I've seen people that have done married filing jointly, and they end up not owing taxes either way if they were separately or jointly, but just jointly has the extra hassle of having to involve their spouse. So again, case by case situation, maybe in your case it makes sense. In most folks, it makes no difference if in terms of taxes owed or, a refund if they're married jointly or separately.
Okay. Mary Jo says, if a dependent child has 5,000 euros in earned income, does this affect the parents' filing?
In unearned income, right?
In earned income, it says.
In earned income.
Yeah.
So normally not. So again, it really depends. Like there's quite complex rules for dependents filing. I didn't memorize all of them, so you can't quote me on this. You can find them on the 1040 instructions. There's like a whole chart about for dependent children. But generally, filing requirements for children are only triggered if they're either their earned income is completely over the filing threshold, right? So then they just have to file their own tax return. Or they have unearned income and their unearned income is over $1,150, then that income the investment income or unearned income might go into their parents' return. If they have unearned income plus earned income, in this situation, even if it's not over the filing threshold, this might trigger that they have to file their own tax return or include it on their parents. So generally speaking, if your child only has earned income and it's under the filing threshold, this should not affect you. You shouldn't have to report on your tax return. If their earned income is from self-employment income, remember that filing threshold is $400. So that might mean they have to file their own tax return. But normally earned income does not affect anything on a parent's tax return. Just in that case, they have unearned plus earned. Again, if you look at the 1040 instructions, they have a whole chart. I can't give you the exact answer otherwise.
No, that was great. Here's one that might affect quite a few people. So it's from an anonymous attendee, but it says, I live in France, but I worked 3 months in the US during last year. How does that affect my filing?
So it depends on what expat tax benefit you're using. If you're using the foreign earned income exclusion, basically what you will see on Form 2555 is that the foreign wages you claim will not include those 3 months you worked in the US. So you have to calculate how much wages you earned in those 3 months, and you don't include that on 2555 when you're excluding it. So technically that income is just fully taxable by the US. I mean, realistically then speaking, on the other side, I assume France is taxing your income, no matter where you work, right? Because you are generally a French tax resident. So in that case, in the US sourced part of your income, you would still be able to claim French tax credits. It would just be that on Form 1116, you would be using kind of resource by treaty, because technically your income is now US sourced, but you're claiming French income taxes. That's a very detailed answer. That's probably more of an answer for your tax preparer than for you in general. Ideally, nothing should really change. You should still not see, any US tax, assuming that France has taxed your income, because France has a high income tax rate. It's just that the way that your income is reported will be a little bit different, right? Because you'll have 3 months of US source income. So then that has to use the tax benefits in a slightly different way. But you yourself shouldn't see a big impact. It's more of the person preparing your taxes will see the impact.
That's great. Here's a good one. Once a year, I have to move over 10K to my foreign account for my residency renewal. The money is only in the foreign bank for 3 weeks, and then I move it back to the US. Do I still need to complete that?
The second it touches your account, for literally a second, the minute you have a maximum balance, that's your maximum balance. So that's a question we get a lot. So people get a house, right? They get a mortgage, they get a huge payment into their bank account that is gone the next day. Doesn't matter. That the minute you have a maximum balance, that is your maximum balance that you have to account for, even if it's not permanent. So sorry, yes, it counts.
My spouse is a EU citizen. We file a joint US return. Does my spouse have to file an FBAR if an account is only in their name?
So your spouse is a US citizen or EU?
No, it's an EU citizen. So it's a US citizen.
Okay. I mean, technically they don't need to file an FBAR. So again, don't completely quote me on this, but for the FBAR, generally, even if you're filing jointly, if your spouse is not a US citizen, they don't have to file a US or a FBAR. So you will include the joint accounts on your FBAR, right? But they don't necessarily have to file an FBAR themselves, right? Because they're not a US citizen. This is a rule for US citizens. So no, they generally don't need to file an FBAR themselves.
Even though they're included on the joint return?
Even if they're included as a joint filer. There was a very specific call out, I remember, from the Treasury to handle the situation. But, send me an email. Again, don't quote me because I don't memorize every single tax rule, but I'm pretty confident that no, you do not have to file an FBAR if you're not a US citizen, even if you're filing jointly. But you can always send us an email at team@myexpattaxes.com to make sure.
Here's another FBAR related one. If we have both foreign accounts and US based accounts, do we include the USA accounts also on the FBAR?
Only foreign accounts. FBAR is really for only foreign financial accounts, right? Pretty much when you fill it out, they're going to ask for the address, and you're not supposed to put US addresses there. So again, if your account has a US address, it does not belong on the FBAR.
Great. So somebody else says, I am based in France, but my primary client right now is is US based. And how does that affect reporting my income?
So I assume you're self-employed when you say primary client. So, you know, your primary client in the US and you get your income from them. It doesn't affect you at all, right? You are in France, you're working from France. It's self-employment income, I assume. So self-employment income is earned where you physically are when you earn that income. So if you're physically in France earning that income, it's still counted as foreign self-employment income, regardless of where your clients are. So for federal taxes, it doesn't make a difference where your clients are.
It's where you are.
It's where you physically are
when you're working. Yeah. Okay, here's one. How do I report a foreign pension if I don't have a 1099?
I mean, foreign pensions would never have a 1099, right? I don't think any foreign financial account adheres to the 1099 reporting standards. So foreign pensions are reported normally as pension income on your Form 1040. What you will normally do is claim foreign tax credits against it. So you would see a Form 1116. In the event that the foreign pension is maybe a government-funded pension, so more in the realms of Social Security benefits, it might be possible to use a tax treaty benefit to, you know, basically exempt that income from taxation. You still have to report it, but it can be exempt from taxation.
Here's one. If a pension is tax-free in this case in the UK or in another country, I'm sure there are equivalents of sort of tax advantageous pension schemes, pension plans. Is it also free on my US tax return?
So the UK has a very specific tax treaty clause for the 25% lump sum tax-free distribution. So in this case, that would actually also be tax-free in the US. This is very specific to the UK. I cannot say it's for any other country has this, but for UK tax-free pensions, if they're in this 25 lump sum kind of tax-free thing, there is actually a specific tax treaty benefit for that you can claim on your US tax return.
Somebody says, Joanne says, if you're self-employed, do you have to file Form 8858?
So we generally recommend it. So Form 8858 is basically for a foreign branch of, you know, a self-employment role, right? And the thing is, if you really look at the rules behind it, how the IRS defines this is that is a US citizen, your HQ is in the US. So the minute you work abroad as a self-employed person, you have a business abroad, you have, you know, a business address abroad, you have business bank accounts abroad, you technically have a foreign branch of your HQ, even though you don't have a US HQ. So yes, we generally recommend you should file 8858 because it's, again, one of these forms with a $10,000 penalty. And at that point, you don't want to be subject to these penalties, right? You should just include the form. It's basically repeating the exact same information as your Schedule C, right? A little bit more on, like, you know, taxes paid and, you know, how much is in your business bank accounts, but it's basically the same information. It's purely informational reporting. There's really no extra tax reported on it. And we would say the way we guide our users is if it's an ongoing self-employment role and it's normally based abroad, right? You have a business address, you have business bank accounts abroad, you should file 8858.
There are a few questions about whether different types of income count as earned income, such as unemployment compensation. Doesn't sound like it would be earned, no. Student loans, is student loans subject to US taxes?
Yeah. Okay, so I break down the question. Earned income is really income that you physically, like, basically you actively work for it, you actively earn it. So this normally is salary, self-employment, active partnership income. You know, in the realm of rental income, if you're managing the rental property, if you're actively doing stuff for it, like you're cleaning the rooms, you're providing breakfast, right? You're operating a business, then that would probably fall into self-employment, not really rental anymore. But it's these types of income that you actively do stuff for. Now, unearned income is basically everything else, right? So it's investment income, right? You put money in, you don't actively do anything, you just hope that you get money out. Rental income is normally a passive activity where you put up your, your property up for rent, maybe someone else manages it. Unemployment is not earned income. This is someone's kind of giving you this income. Obviously you did work for it. So it depends. If that unemployment income is like a severance payment, right? That's paid from your company, that could be then grouped into wages, which could be earned. But if it's an unemployment payment from the government because you're unemployed, it's not earned income. So that's kind of the first part of the question. The second part is student loans. So student loans, I mean, that's not income that you get, right? You're paying someone back the loans and interest. Student loan interest, you can definitely deduct on your tax return. You could try. The next part is obviously, it hasn't gone into effect yet, but the whole Biden student loan relief. Technically, if you do get the relief, that is not counted as taxable income on your federal tax return. I hope I answered that question.
No, that's great. Yeah. I'm conscious we're coming up to the hour. There are a lot of questions still, and I would say to our audience members, if you haven't had your questions answered, to either drop Nathalie an email, and we have more tax experts coming on sessions later on today as well. Here's another one. We live in a high tax EU country where we will likely pay more foreign tax than US tax. If we will not owe US tax in the end because of the foreign tax credit, should we still pay estimated US taxes only to get them back as a refund?
There's no reason to. I mean, it's up to you, right? If you don't miss that money, then why not? But if you don't owe taxes, there's no reason to pay estimated tax payments. So again, keep in mind, you only make estimated tax payments, right? So those quarterly estimated tax payments, if you expect to owe over 1,000 in taxes, right? And if you owed over 1,000 basically in the last year. So if you've never really owed taxes on your US tax return, there's no reason to pay the estimated tax payments, first of all, right? That's only for people that are owing over 1,000 in taxes. The second thing is, yeah, if you don't, there's no reason. You can, people do it. I see people obviously, if you want to be safe and you want to make sure the IRS doesn't ever surprise you with a bill, go for it. It doesn't really impact you, but of course you could be using that money for investments or something else. So if you pay, then it takes you a little while to get it back. So that's my long-winded answer to this more simple question.
That makes sense. Let's just find one more. It's hopefully one that's quite general. Expat with sole proprietorship in a foreign country, do you need to file Schedule C?
Yes.
That's a great one-word answer. Let's do another one. Do I need to file state tax if I used to live in MA?
Depends. MA is Massachusetts, also one of the harder states. Again, normally state taxes, it comes down to the first one, are you still seen as a resident? So being a resident depends on every state, but it's generally, are you in that state for more than half of the year physically? Do you still own property in that state, right? I mean, do you still vote in that state for, state elections, things like that? Federal elections are always, they will never trigger any state filing requirement. But local elections and state, those are something to consider. Do you still, if you go back to the state, do you still have your dentist and doctor there and you visit them? Like, I'm telling you, when it comes to state residency, every state's different. They have kind of different checklists and they're pretty gray area. So just because you own property doesn't mean you're a resident, just because, you check one box, etc. But basically, first question, are you still a resident? Does the state still believe you're a resident? Most will say no because they're an expat and they live abroad. The second one, do you have state source income? Did you work out of the state? Did you get some type of state payment, like you have rental property from the state? If you have state source income, you probably have to file a state tax return. If you are not a resident, you have no state source income, you probably don't need to file a state tax return. So that's my very general answer to that. But it all comes down to the residency question, which is super gray area. Almost every state just has like a checklist of it. I think the only thing that's not gray area is if you spend more than 6 months in the state.